Hello and welcome to Business Standards Morning Show. I am Ruchika Chitravanshi and let us take a look at the headlines for today. Its November debut on the Lal Street was disappointing, eroding over half of investors' wealth. And last Friday, Paytm announced that it will wind up its operations in Canada. Its shares touched an all-time low of rupees 995 that day before making some recovery. Most market experts are now asking investors to wait and watch before the company's business model stabilizes. So, what is happening inside the country's fintech giant? Our next report offers a peek.
2021 may well be summed up as the year of startup IPOs. They finally came of age, mostly because of unexpected windfall during the pandemic. The market saw 8 startup IPOs last year, but the clear leader of the pack, Paytm, turned out to be a lame duck. While it was India's biggest IPO ever, as it looked to raise 18,300 crore rupees at an issue price of rupees 2,150, the fintech firm's shares plummeted soon after its public market debut. Market experts, brokerages, and investors were spooked by the company's long-term financial prospects and timeline for attaining profitability. 2 months later, the negative sentiment around Paytm stock hasn't abated. On January 17th, the company's stock was trading at Rs 1,099, more than 50% lower than its issue price. The stock hit a high of Rs 1,961 on November 18th, but has failed to touch its issue price since listing. So what is ailing Paytm? In a report on Paytm soon after its listing in November last year, financial services provider Macquarie Research had said, Paytm has fingers in too many pies. Achieving scale with profitability is a big challenge and the company is a cash guzzler. Regulations and competition are added worries. Macquarie's previous target for Paytm was Rs 1,200 in November, but last week, retaining its lowest rating for 197 communications, Macquarie further cut its target price to Rs 900. Implying a 25% downside from current levels. Macquarie explained its reasons. The RBI could curb wallet charges as it reviews the charges levied on customers across various digital payment modes. Prepaid payment instruments and wallet companies like Paytm, MobiKwik, PhonePe, FreeCharge, Amazon Pay, etc. charge customers anywhere between 2% and 2.5%. The payments business still forms 70% of Paytm's overall gross revenue, and hence any regulations capping charges could impact revenues significantly. Also, the Insurance Regulatory and Development Authority of India's recent decision not to grant an insurance license to Paytm could affect the fintech firm's chances of getting a banking license. Senior management attrition and a fall in the average ticket size of loans disbursed to Rs 5,000 are other factors that impact the company's long-term financial prospects. JP Morgan, Morgan Stanley, and Goldman Sachs have however set a 1-year price target of between Rs 1,630 and Rs 1,875 on Paytm. The three were among the lead bankers for Paytm listing and have cited the company's strong network effect and cross-selling opportunities as strong levers for growth. Paytm CEO Vijay Shekhar Sharma has said that the company's share market performance has been in line with that of global peers in the sector over the past 6 months due to macroeconomic factors. On the question of small ticket size of loans, Sharma has said that it is by design to ensure better quality of loans. Sandeep Sabharwal shares his views on why Paytm shares are under pressure.
So what's ailing the stock essentially is that there seems to be no strategy as far as the company goes for making profits. So in a easy liquidity scenario as we saw last year and funds being available and a lot of money going into new generation startups, the valuations of most of the companies shot up rapidly. However, I think as people reassess the risk, what they are saying is that in most of the businesses, Paytm is in competitive intensity is increasing, and they are getting into the lending business. So I think their lending book is actually expanding quite rapidly, which by itself could be a risk going forward because lending is a tough business where giving money out is easy, but getting it back is difficult. And most of the banks also find it very tough to control their NPAs. the new generation fintechs will find it very tough to operate in that space. I think there are various issues which investors are grappling with as far as companies which are loss-making and where the management say that will continue to be loss-making for the next several years.
While Paytm has made its presence in digital payments, going forward, its execution in financial services and cloud segments will be watched closely. Investors will also look at how Paytm will monetize its bevy of services in a highly competitive industry.
Despite the recent developments, experts are hopeful that Paytm will bounce back to win investors' confidence. And despite the pandemic, 99% CEOs in India foresee a stronger economy in the coming year. And when it comes to the revenue prospects of their own companies, 98% of CEOs are confident about growth in the same time period. These are the India highlights from PwC's 25th annual Global CEO Survey. To get a better understanding of the sentiment among the Indian CEOs, Business Standard's Bhaswar Kumar spoke to Sanjeev Krishan, the chairman of PwC in India. Let us listen to the interview.
Mr. Krishan, welcome to the show. Let's begin with the key finding. According to your survey, 94% of India CEOs, as against 88% last year, feel that global growth rates are poised to increase, while 99% of India CEOs believe India's economic growth will improve over the next 12 months. What, in your opinion, would drive this growth given the current uncertainty?
Yeah, I think the first thing really is that this survey was done in October and November. Maybe towards the end, the Omicron wave was just going to hit us. So maybe the response do not consider the impact of the Omicron challenge at large. But having said so, I think clearly the Indian CEOs appear largely sanguine because of the way they have come through the last 2 years. I think there was a lot of anxiety over 2020 and 2021, but we have come out reasonably unscathed from that. In fact, we keep talking about the K curve, and in many discussions that now it is now we keep discussing that the curve of the K has actually moved a little bit for the right, so to speak. So in a way, I think it's about how the last 2 years have gone. Continued support from the government, etc., has been key. There was a concern about how the mid corporates are going, and what it might do to some of the smaller businesses, etc. I think there has been enough support from the government on some of those as well. We have had a reasonably benign interest rate policies which have continued, and I think this has all got the confidence. And most importantly, the consumption patterns are now back. I mean, the consumption numbers have kept pace. You can see that in the GST numbers, which continue to be very, very robust. So in some ways, I think unless of course there have been lockdowns and others, I think the economy has continued to do well. And now, as we are almost nearing capacity utilization, there is this expectation that there will be a revival of the capital cycle. As and when the the revival of the capital cycle happens, it would start a new era of growth, so as to speak. And invariably, it starts from areas which are fairly accretive to GDP, including construction and real estate and so on and so forth. So at some level, the ability of India's ability over the last 2 years to weather the COVID challenge and the opportunities that global supply chains and the geopolitics of the world have thrown to India over the last 2 years, we believe are keeping Indian CEOs quite sanguine about the growth that they can expect.
89% of India CEOs are concerned about health risks. With that in mind, how will the new Omicron-led waves in India and other countries of the world impact the economic recovery that had started, both at home and in the world at large?
I would say that possibly most of them would look at this as a short-term blip because we obviously in 2021 we went through a very significant. The second wave was pretty significant, and it did impact businesses, and there were lockdowns, and people were just not available. We talk about supply side challenges. There was labor issues, and people were just not available. Forget the material side. So I do believe that this is again another hiccup that we would expect from a growth perspective. But I would like to believe that, and in most of my discussions, it appears to be a bit of a transient thing. Look at what's happening globally as well. I mean, if you look at it, there are significant opportunities across the globe which are emerging from an India standpoint, and I refer to some of those. Whether it is a supply chain issue, which is there, whether it is the significant inflation that some of those countries are experiencing, which would again create opportunities for countries like India. I do believe that it is going to be a transient issue and not something which is going to impede our prospects for 22.
77% of India's CEOs are worried about geopolitical conflict. With that in mind, what are you hearing from CEOs on the current geopolitical situation and what is its impact on business?
Everybody is looking a lot more internally, and as everybody looks at it a lot more internally, they want to localize supply chains, which obviously means that they are spending a whole lot more. We have seen some of the inflationary trends that particularly some of the Western countries are experiencing, and also what that might mean for India. I mean, just imagine, if the interest rates were to start going up in the West, and there is a pullback of capital from India. It impacts the stock markets and impacts consumer sentiment. And when it impacts consumer sentiment, it possibly impacts consumption in India. I mean, that's one way to look at it. And, the consumption that we were talking about possibly starts getting a little bit muted and hence starts impacting Indian growth. That's one way to look at it. The other way, obviously, to look at it is that obviously some of the geopolitics, particularly, if I may say so, the economics of the world getting aligned under two broad blocks could create opportunities for India to be able to fulfill the supply chain requirements of, let's say, a particular segment. And that could create significant opportunities considering the incentivization that the government of India is doing, particularly on the manufacturing side of things. When I say this, it is not just the manufacturing side. We continue to remain quite robust on the services side. We've seen that in all our technology and our services companies. So supplemented with the growth that we have already experiencing on the services side, if the manufacturing side can actually aid to it, that would be an opportunity. So those are the two sides of the coin. I suppose, if I were to answer your question, I think while there is a risk on the first, there is a huge opportunity on the latter.
As has become the common wisdom thanks to the experience of the past 2 years, whether or not CEOs across India are justified in their optimism will be decided by the severity of the ongoing Omicron-led wave and our success or failure in preventing another round of strict lockdowns and curfews.
The Indian CEOs may well be bullish about the country's economic growth, but news from far shores is causing some worry. Brent crude prices have soared about 25% in a month as demand remains steady and supplies disrupted. And analysts expect prices to rise further. Now, as India remains one of the key importers of oil, is this a worrisome trend for us? Will the government address this in the upcoming budget? And how can investors benefit from rising oil prices? Watch our next report to find out more.
Oil prices have been on an unabated uptrend for more than a month now. From a low of $69 per barrel hit on December 1st, 2021, Brent crude prices are above $86 per barrel now. This amounts to an approximate jump of 25% in 4 weeks. Last Friday, crude prices notched a fourth positive week, its longest rising streak since October. This is because consumption has held up despite the spread of the Omicron variant of the coronavirus. At the same time, spare capacity is dwindling as some of the world's biggest producers struggle to boost output. And now, analysts are predicting higher oil prices, citing limited capacity, insufficient investment in new production, and the strength of demand. Technically too, one can expect Brent crude hitting $88 per barrel mark. According to a report by Reliance Securities, if Brent March contracts hold above $85.50 level, they could continue their bullish momentum up to $87 to $88. But what does all of this mean for India? Remember, The Indian government is set to unveil its budget for FY23 in about 2 weeks from now, and the document has a major influence on the price of petrol and diesel. Given that 5 state elections are due next month, analysts don't expect the government to raise the prices of petroleum products. It is estimated that every $10 rise in crude prices raises fiscal deficit by 10 basis points. Moreover, higher cost of petroleum imports worsens the current account deficit too. Given this, VK Vijay Kumar, Chief Investment Officer at Geojit Financial Services, believes rising crude prices can pose problems to the finance minister's pursuit of fiscal consolidation in the budget. Rising crude prices and inflation will also force the RBI to withdraw from the accommodative monetary policy it has been following for the last 2 years. Echoing similar views, Devendra Kumar Pant, Chief Economist at India Ratings and Research, says prices may be passed on to consumer if the government doesn't cut petrol prices.
You have a firm handle, and because of other taxes and duties, you are able to collect good amount of revenues. Then there may be some cut in your excise. But if the government is finding it difficult or hard to meet the deficit, then it is unlikely that there will be further cut in the excise duty. The cushion right now is depending on if you are satisfied with 6.8% of the deficit is the level at which you are satisfied, then there is fine. But if you are satisfied with 6, if you are saying okay, it has to be 6% or 5% or 5.5%, there is no cushion. Because 6.8 is already a high deficit number.
That said, M. Govind Rao, Chief Economic Advisor at Brickwork Ratings, says, with the impact of the third wave hurting growth, the RBI will be slow in raising interest rates so long as the inflation rate is below 6%. It must also be noted that the weight of fuel and light in the consumer price index is just 6.84. Therefore, the impact of oil prices on overall inflation will not be large. Thus, while rising crude oil prices may disturb the government's fiscal maths, here's how investors can benefit from the same. According to IIFL Securities, if Brent was to average at $85 per barrel for FY23 on unchanged costs, it can potentially lead to 11 to 14% net profit upgrade for ONGC and Oil India Limited. Similarly, OMCs may see 14 to 16% upgrade to FY23 PAT, assuming they revise pump prices. RIL's earnings will also see an upgrade of 5%. Other oil-linked stocks such as Pidilite Industries, Berger Paints, and Hindustan Oil Exploration Company are eyeing up to 11% upside on tech charts. Against this backdrop, rising crude oil prices may keep indices volatile in the near term. Q3 results of Bajaj Finance, LTTS, ICICI Prudential Life Insurance, and Tata Elxsi and other global cues will also guide the markets on Tuesday.
The rising oil prices may well dent the country's exchequer. Let us now move on to gadgets. What happens when your pricey phone gets a dent or worse, stops working? You visit its service center. But what if you are told that the company has stopped supplying its parts and has now moved on to an upgraded version? After foreign shores, the right to repair movement is now gaining ground in India. Our next report tells us more about it.
The consumer technology space is bustling with upgraded versions of smartphones, laptops, and wearable devices being released every few years. But what happens if something goes wrong with your pricey gadget? You take it to a company authorized service center only to find that the price of repair is out of your budget. You'd rather spend a little bit more and buy another product itself. Apple routinely puts certain older versions of its products on the obsolete list. This means that Apple stops offering hardware support for those products at its service centers. Most manufacturers of electronic devices also dictate who can repair the products by authorizing only a few select service centers and by making it a very pricey affair for the average consumer. Consumers are now questioning all of this as part of the right to repair movement. The US has passed a law to this effect. In July 2021, US President Joe Biden called on the Federal Trade Commission to curb restrictions imposed by manufacturers that limit consumers' ability to repair their gadgets on their own terms. And the UK's right to repair law came into effect from July 1st. It requires appliance manufacturers to provide consumers access to spare parts and make complicated parts available in professional repair shops. Proponents of the right to repair movement argue that such laws would boost local repair shops and small businesses. They point out that the purchase of any electronic device signifies a shifting of power and ownership from the manufacturer to the consumer. As such, the consumer should be able to repair their own product the way they deem fit, instead of relying on the manufacturer. They also argue that electronics manufacturers are working around a concept of planned obsolescence. This means that electronics devices are built to last only for a specific period of time, after which they are meant to be replaced. You might be using an older version of the Apple MacBook, which will be moved to the obsolete list in a couple of years. So once you start facing some performance issues with your older MacBook, you won't be able to get it repaired anywhere. In this case, electronics manufacturers artificially reduce the lifespan of their products. Right to repair advocates also talk about curbing environmental stress by mandating electronics manufacturers to allow third-party repair of their products. Electronics manufacturers, meanwhile, are opposing the right to repair movement. They are arguing that opening up the intellectual property to third-party repair shops could jeopardize the safety and security of the devices. And in the era of phone hacks and cyber attacks, one cannot brush aside such concerns either. Interestingly, Apple co-founder Steve Wozniak recently voiced his support for the movement. He said, and I quote, "We wouldn't have had an Apple had I not grown up in a very open technology world." The tech giant has long been criticized for allowing repairs of its devices only by authorized technicians and not providing spare parts or manuals on how to fix its products.
Those who have seen the entry of home appliances like sets of Crown, Bush and Weston, or Godrej and Kelvinator refrigerators may remember passing them to the next generation, well, in most cases. That's all we have for you now. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.